All right, welcome to this explainer. Today, we're basically putting on our sell-side equity analyst hats to conduct a rigorous, fully documented intrinsic valuation of perimeter solutions, or PRM for short. We're going to build this analysis strictly from the ground up, using the absolute latest reported financial metrics to try and uncover the true underlying value of this business. So let's just jump right to work. Okay, let's dive straight into the massive paradox at the very heart of this explainer. Get a load of these numbers. We have a trailing 12-month net income sitting at a colossal negative $206 million. Ouch, right? Yet, at the exact same time, the company is somehow generating over $193 million in positive free cash flow. Honestly, you might be wondering, how on earth does a company bleed out completely on the income statement, but literally print cash on the cash flow statement? Well, that massive divergence between the accounting profits and the actual cash generation is exactly why standard, off-the-shelf metrics totally fail us here. So how do we value a paradox like this? We've got to open up the analyst toolkit. We are going to run the raw data through strict, absolute, and relative valuation models. Our goal? To filter out all that accounting noise and pinpoint the true intrinsic value per share. Here is our roadmap for today's analysis. We'll hit rules and assumptions, absolute valuation via the DCF, bypassed models, relative valuation, an asset-based check, and finally, synthesizing intrinsic value. Let's kick things off with part one, rules and assumptions. Look, any rigorous analyst knows a model is literally only as good as its inputs. And since the raw data filings don't hand us the exact capital structure costs or a neat little list of explicit peers, we have to declare some sensible external defaults so our models actually function accurately. We're assuming a baseline weighted average cost of capital, or WACC, of 8%, a long-term terminal growth rate of 2.5%, and an externally assumed peer group for our relative metrics. You know, if we tweaked that WACC just a bit higher, our valuation drops pretty quickly, so we're keeping it at a conservative, standard market baseline. Moving right along to part two, absolute valuation, the DCF approach. Now, what is truly staggering here is PRM's 3-year free cash flow compound annual growth rate. It is 81.24%. Just think about that. While their 5-year average is a still impressive 35.42%, this recent explosive cash generation heavily dictates the inputs that we're feeding into our explicit forecast period. So when we take that reported trailing free cash flow of roughly $193 million and we bridge it to the present value using our declared 8% discount rate and that 2.5% terminal growth, boom! Our step-by-step calculation yields an exact intrinsic fair value of $27.36 per share. And it's really crucial to note here that the data sources validate this exact DCF output, completely confirming our absolute valuation baseline. Next up, Section 3, addressing bypass models. You know, sometimes the tools you leave in the box are just as important as the ones you use. We absolutely must objectively bypass the dividend discount model entirely, simply because the data shows a 0% dividend yield and literally zero payout history. We're also skipping a sum of the parts, or SOTP valuation, due to a total lack of distinct business segment data in the filings. And the residual income model? Severely limited here. With a deeply negative return on equity of negative 18.21%, the equity charge calculations just get completely distorted by those accounting net losses we saw earlier. Oh, and we're skipping the adjusted present value model too, since the company's debt levels appear pretty stable right now. All right, shifting gears to Section 4, relative valuation and multiples. When you analyze the valuation multiples, things get kind of wild. A trailing PE of negative 20 and an EV to EBITDA of negative 38 firmly showcase those heavy accounting losses. But wait, then you look at the forward PE and it completely flips the script, sitting at a super healthy 15.97. What does that tell us? It means the market is aggressively pricing in an anticipated operational turnaround and future earnings growth, which is heavily supported by that solid price to free cash flow ratio of 22.36. And this comparison right here really brings it home. It brilliantly illustrates the premium the market is currently assigning to this company. The market is valuing PRM sales at a ratio of 6.85. Compare that to its 3-year historical average of just 4.26. That means investors are cheerfully paying a nearly 61% premium for every single dollar of sales today compared to the recent historical average. Crazy, right? Which brings us to Section 5, asset-based valuation approaches. Now, we don't have explicit line-by-line liquidation items in our dataset, but we can definitely still do a conceptual step through of the net asset value. By noting the enterprise value to assets ratio of 1.86, we can see the market values the firm significantly higher than just its base assets. Couple that with a moderate debt-to-equity ratio of 0.70, and we're looking at a relatively stable capital structure. It provides a decent floor of downside protection, even if an exact to-the-penny liquidation value isn't perfectly clear. Finally, we arrive at Section 6, Synthesizing Intrinsic Share Value. Okay, moment of truth. Let's look at the ultimate comparison. Our rigorous discounted cash flow model gave us an implied intrinsic value of exactly $27.36. Now check out the last market close price for PRM, $27.41. That leaves us with a margin of safety of negative 0.20%. In the world of valuation, that is practically a mirror image. The market is pricing this stock almost exactly at its calculated intrinsic value. No wiggle room at all. But hold on, you've got to keep the sheer scale of the context in mind here. This insanely tight valuation comes right on the heels of a massive 165% trailing 12-month price surge. The stock has run up incredibly fast over the last year just to arrive precisely at this fair value baseline. So, I'm going to leave you with this final provocative thought to chew on. When a stock's market price matches a highly rigorous intrinsic model basically down to the penny, after a blistering 165% run-up, and while trading at a massive historical sales premium, are we witnessing a rare, beautiful moment of perfect market efficiency? Or are we simply staring straight at the calm before a fundamental correction? Think about that as you review your own portfolio. Thanks so much for joining me on this explainer, and remember, always keep questioning the data.